In parts of Sydney and Melbourne right now, some suburbs have households where every single mortgage holder is under financial stress. Not most, all of them. That's according to a new report released this year by Digital Finance Analytics, which tracked mortgage stress across every postcode in the country. Suburbs like Campbelltown, Riverstone and Mount Druitt in Sydney's west showed 100% of mortgage-holding households under strain. In Victoria, Berwick and Essendon topped the same list. This has been building for a while, but the last few months have made it a lot more visible. So let's actually break down what's going on suburb by suburb and why Western Sydney and Melbourne's outer suburbs keep showing up at the top of every one of these reports. Before we get into it, if you want these updates as soon as new housing data drops, hit subscribe now. This market is moving fast and I'll keep breaking it down as it happens. Quick thing before we dive in, because you'll hear a few different terms in this video and they don't all mean the same thing. Mortgage stress means a household is barely breaking even after paying the mortgage and covering basic living costs. Severe mortgage stress is a step further. That's when a household is losing more than 5% of its income every month just to keep up. Arrears is different again. That's when someone has actually missed a payment, usually by 30 days or more. And distressed listings means a property is being advertised with language like must sell or urgent sale, which usually signals the seller is under real pressure to offload it fast. Right now, Western Sydney and Melbourne's west are showing up near the top of almost every one of these categories. Here's what that actually looks like on the ground. Sydney overall recorded the highest concentration of mortgage stress increases of any capital city in the country in the first quarter of this year. Every single one of its 10 highest stress postcodes got worse, not better, over that quarter. Western Sydney suburbs are a big part of that. Blacktown keeps showing up near the top of both mortgage stress and negative equity data. Campbelltown, Riverstone and Mount Druitt were named as suburbs where every mortgage-holding household is under stress. And if you go back through last year's arrears data, suburbs like Cashela, Cambridge Gardens and Berkshire Park were already sitting well above the state average for missed payments. Cashela alone was above 2.5% compared to a state average sitting under 1%. So why Western Sydney specifically? A couple of things are compounding each other here. A lot of buyers in these suburbs took out large loans when rates were near record lows a few years back, often stretching close to their maximum borrowing capacity to get into the market at all. Now that rates have gone up 3 times this year, those same households are absorbing much bigger repayments on the exact same loan. Add rising grocery and energy bills on top of that, and there's very little room left in the budget. Brokers on the ground are seeing this play out before it even shows up in the official numbers. One Sydney broker described clients stretching their loans out to 30-year terms just to lower the monthly repayment, while running on savings buffers as thin as $10,000 to $20,000. Some are even cutting back on insurance to make the mortgage work. That's usually the first sign that shows up, long before a suburb starts appearing in a distressed listings report. Now Melbourne. For a while now, ratings agencies have referred to Melbourne as having the highest concentration of mortgage arrears of any capital city in Australia, and a big part of the reason is unemployment. Victoria's jobless rate has been sitting noticeably higher than the rest of the country, and when a region's job market is softer, mortgage delinquencies tend to follow. Western Melbourne is where a lot of this shows up. Suburbs like Caroline Springs, Sunshine and Deer Park have all seen a rise in forced and distressed sales. But the sharpest recent moves are actually coming from the outer growth corridors. Point Cook, Werribee and the wider Wyndham area saw mortgage stress jump more than 50% in a single quarter earlier this year. Frankston and Coringal weren't far behind, up close to 28% over the same period. Here's the pattern that keeps repeating in these newer growth suburbs. Mortgage stress rises first, then listings start increasing, then properties sit on the market longer than they used to.
And only after all of that do prices actually start to soften. Several of Melbourne's growth corridor suburbs are already sitting in the middle of that sequence right now, not at the start of it. That's part of why Melbourne's overall property values have been sliding. As of May this year, Melbourne's dwelling values were down close to 3% from their late 2025 peak, and Sydney wasn't far behind, down around 2% from its own high a few months earlier. Nationally, prices barely moved at all in May, and the two biggest cities are the main reason why.
Let's talk about the piece tying all of this together, because it explains why this is happening now specifically. The Reserve Bank raised the cash rate 3 separate times in 2026, taking it to 4.35%. That wasn't really about the domestic economy overheating. It was mostly a response to an oil price shock triggered by the conflict in the Middle East, which pushed inflation back up just as households thought the worst of the rate cycle was behind them. The board held rates steady at its June meeting, and the next decision lands on August 11th. Here's why that date matters. A key inflation reading comes out on July 29th, just 2 weeks before that meeting, and it's expected to be the deciding factor. Westpac is still forecasting one more hike, which would take the cash rate to 4.85%. The other major banks, NAB, ANZ and CBA, are leaning toward a hold instead. Either way, nobody's forecasting a rate cut before next year. For households in the suburbs we've just covered, that uncertainty matters more than it does almost anywhere else. These are the borrowers with the least buffer left to absorb another increase. One more 0.25% move might not sound like much, but on an already stretched loan, it can be the difference between getting by and missing a payment. So here's the state of play as of this month. Nationally, distress listings ticked up close to 11% just in June, even though they're still running a bit below where they were this time last year. Roughly a quarter of all mortgage holders across the country, somewhere around 1.3 million people, are currently classified as being at risk of mortgage stress. The headline numbers still look reasonably calm. Arrears overall remain below where they sat before the pandemic, but that national average is hiding a lot of regional pain, and Western Sydney and Melbourne's West are absorbing far more of it than the averages suggest. If the RBA holds rates from here, some of these suburbs may find their footing. If there's one more hike in August, expect these same suburbs to be back in the headlines before the year's out.
That's why homeowners, renters and investors in these particular pockets of Sydney and Melbourne are watching the next RBA decision more closely than almost anyone else in the country. The pressure isn't spread evenly. It's landing hardest on the households that already have the least room to move. If this helped make sense of what's actually happening, let me know in the comments which suburb you want covered next, and subscribe so you catch the next update as soon as the July 29th inflation numbers land.